The first property I'll discuss is our Ashburn Center property in Ashburn, Virginia. This transaction is a classic example of how resetting the basis of a property and putting the asset in stronger ownership can help capture existing market demand and drive leasing. Ashburn Center is a 194,000 square foot, 3-building property in the heart of Ashburn, a highly attractive submarket with great access to Dulles Airport and routes 28 and 7. Ashburn is also a major internet hub, with nearly 80% of the North American internet traffic passing through here. We sourced this asset through a long-standing relationship with the developer MRP. In fact, we had looked at partnering with MRP to develop this asset in 2007, but chose not to participate because we didn't think market rents could justify the anticipated $140 per square foot base building cost, which is before tenant improvements and leasing commissions. In late 2009, after the buildings had been completed, MRP approached us because they sensed that the lender, who had a $24 million loan against the property, would be willing to negotiate a discounted payoff if a transaction could be completed by year-end 2009. Given our familiarity with the property, the submarket, and the developer, we were able to act quickly and close on the asset in late December 2009 for $14 million, or $72 per square foot, a 50% discount to the $140 per square foot base building price. We also gave MRP a subordinated residual position that incentivized them to help us get the deal done and lease up the asset, and allow them to recoup some of their lost equity if the project turned out to be a success for First Potomac. And the property has been a great success. At the time of acquisition, Ashburn was only 40% leased, and within 4 months, we had the property fully leased to strong tenants. The property will be fully occupied in early 2011. Our ability to creatively source and structure this deal allowed us to get access to a high-quality asset at a great price, and our low basis helped us to lease it up quickly, producing a great outcome for First Potomac shareholders. The next property I'll discuss is our 3 Flint Hill redevelopment in Oakton, Virginia, just off I-66 at the Route 123 interchange. We acquired 3 Flint Hill in June of 2010, and it is another great example of how our relationships and creativity allowed us to source a high-quality asset at a price that will allow us to create excellent long-term value for our shareholders. 3 Flint Hill is an 8-story office building with 180,000 square feet of leasable area. The property had been occupied for over 20 years by Lockheed Martin, but Lockheed Martin had consolidated its operations out of the property into a more modern building when its lease at 3 Flint Hill expired in 2008. A local investor, who we knew well, had bought the first mortgage loan on the property and was looking for an exit strategy. They had foreclosed on the property but did not want to be long-term owners, and they were unwilling to invest the capital that was required to modernize the asset. We were a logical buyer and were able to negotiate an attractive price for First Potomac. Our business plan is to reposition the asset, which is in a great location but needs some capital and modernization. We are almost complete with a total interior renovation as well as exterior enhancements that will bring the building to a Class A LEED certified status, the only building of its kind in the submarket. Upon completion of the redevelopment, we will own the asset for roughly $130 per square foot, or about 50% below replacement cost, a low enough basis that should allow us to capture market demand and lease up the asset to generate a very compelling return for FPO shareholders. Our ability to creatively source and structure this transaction allowed us to get access to a high-quality asset at a great price, improving the overall quality of our portfolio while maintaining significant upside potential. Our success at Ashburn showed us the power of resetting the basis of a well-located, high-quality asset with a dedicated, well-capitalized owner. So when AEW introduced us to Aviation Business Park in the fall of 2010, we knew it was another great opportunity. Aviation Business Park is adjacent to the Baltimore-Washington International Airport in Glen Burnie, Maryland. The property is a newly constructed, single-story, Class A office park totaling 121,000 square feet. When we were introduced to the property, it was 13% leased and encumbered by a $10.6 million loan. We learned that the lender was interested in selling the loan, and we knew the developers and understood they were interested in working something out. We first bought the loan from the lender for $8 million, then worked with the previous owner to complete a friendly foreclosure to get fee ownership of the property. We then placed the property into a 50-50 joint venture with AEW. Our basis of $66 per square foot is highly attractive compared to a replacement cost of nearly twice that. And given the low basis and attractive submarket, we are confident we can lease the asset up in a couple of years, generating a compelling 10% or greater return for AEW and our shareholders. This acquisition is another example of how our relationships and creative approach to transactions allow us to source attractive acquisitions with high growth potential at great prices. Our next value-added acquisition was Redland Corporate Center in Rockville, Maryland, which we acquired in November of 2010. Redland consists of two Class A LEED-certified office buildings located just off I-270 in close proximity to the Shady Grove Metro Station, the Intercounty Connector, and a number of amenities in the adjacent King Farm neighborhood. Redland is a classic example of our balanced approach to investing. The first of the two buildings is a 139,000 square foot, 6-story office building fully leased to BAE Systems through 2020. The second building, which is 208,000 square feet, was 99% vacant at acquisition, and we recently signed leases bringing the property to nearly 50% leased. We acquired both buildings for $86 million by buying the joint venture interest of a local developer's capital partner. The local developer, Perseus Realty, bought the opportunity to us because they were seeking a partner to infuse new energy and fresh capital into the property to get it leased. Our ability to move with conviction and to creatively solve Perseus's issues made us an ideal partner. Assigning a conservative market value to the BAE building, we paid about $180 per square foot for the vacant second building and expect to generate close to a 10% return on the second building upon lease-up. This property provides us with significant earnings growth potential, and we expect it to be a solid contributor to our company over the long term. We also closed on Atlanta Corporate Park in the fourth quarter of 2010. Atlanta Corporate Park is our newest lease-up opportunity in Loudoun County. Located in Sterling, Virginia, Atlanta Corporate Park is only minutes from key destinations, including Dulles International Airport, Dulles Town Center, and Dulles Town Crossing. The property is located just off Route 28, south of Route 7, providing excellent access to Leesburg Pike, the Dulles Greenway, and other major thoroughfares. With its proximity to major retail destinations like the Dulles Town Center and Dulles Town Crossing, Atlanta Corporate Park offers walkable access to numerous amenities, including 2 hotels, as well as numerous retail stores and dining establishments. Atlanta Corporate Park is Loudoun County's first LEED Gold office project and one of the only projects in all of Northern Virginia to meet this environmental standard. The project sits on an elevated site and consists of 2 4-story Class A office buildings. Each is 110,000 square feet and share a beautifully landscaped 1-acre park that runs between them. The design of the building offers great flexibility that can accommodate a variety of layouts. We acquired both buildings for $22 million, or $100 per square foot, in an off-market transaction from the developer. We estimate replacement costs of the buildings to be roughly $160 per square foot. Once again, we were able to source a high-quality property off-market and close quickly with conviction, providing strong cash flow growth potential for FPO shareholders as we bring the project to stabilization. Our acquisition of 440 First Street Northwest represents our first foray into downtown DC redevelopment and is yet another example of how our relationships and deep market knowledge created an opportunity for FPO and its shareholders. 440 First Street is located in the Capitol Hill submarket of Washington, D.C., in close proximity to the U.S. Capitol and Union Station. Based on this information, we reached out to the owners of the building who said they might be interested in selling the building, which was on a long-term ground lease. We then contacted the owners of the land and were able to negotiate an off-market purchase of both the building and land for a very attractive price of roughly $24 million. The business plan for this asset is similar to our strategy at 3 Flint Hill. We intend to develop a Class A, LEED-certified office building in a highly attractive submarket that offers tenants a strong transportation and amenity base. Upon a full interior and exterior renovation, we expect to deliver a modernized Class A building to the submarket at less than $400 per square foot, including tenant improvements and leasing commissions. This basis will allow us to lease up the project and deliver very attractive returns to our shareholders. Our most recently announced value-add investment, and one that is extremely exciting for both First Potomac and its shareholders, is the acquisition and anticipated redevelopment of 1200 17th Street in a joint venture with the Ackridge Company. 1200 17th Street is currently an 85,000 square foot building located between M Street and Rhode Island Avenue in the heart of Washington, D.C.'s Central Business District. The property was recently upzoned such that a new 170,000 square foot office building can be built on the site. We expect to close on the acquisition of the building in late 2011 and expect to demolish the existing building in mid-2012 and begin construction of a new building on the site. This was another transaction sourced through our extensive network of relationships and was brought to us by our partner in the venture, Ackridge, who had spent some time getting control of the development site. The opportunity and business plan is for First Potomac and Ackridge to jointly develop a trophy-quality asset, with demolition construction beginning in 2012 and delivery in the 2014 timeframe. We expect the project to total roughly $110 million, or $650 per square foot, a highly attractive cost basis for a trophy-quality office building in D.C.'s Central Business District. The building will have windows on all 4 sides, views will be outstanding, overlooking St. Matthew's Cathedral, as well as expansive views in several directions. The site is a short walk to DuPont Circle and Farragut North metro stations on the highly desirable Red Line, as well as the Farragut West station on the Orange and Blue lines. The property also allows easy automobile access via Connecticut and Massachusetts Avenue, and there is a strong amenity base in the surrounding neighborhood.